Hi, I'm Bob Cromwell. Welcome to Accounting 1030. We're going to talk about the preparation of a 10-column worksheet using problem E4-2 from Chapter 4 on page 126 and 127 in your workbook or page 213 in your text. Now, before we do that, I want to give you a brief introduction about worksheets. The worksheet itself is a columnar device. It's prepared at period end or month end. There's 5 sections of 2 columns each, representing the debit and credit column. Hence, you get the term 10-column worksheet. And like the name indicates, it's rough work. The worksheet, it's an internal document. It's completed in rough work to help with the preparation of, in good form, your financial statements, income statement, statement of owner's equity, and balance sheet. The other purpose of the worksheet is to use the adjustments column to do your adjusting entries. And you want to do them on here before you would put them into your general journal, again in rough work. So let's look at the given information problem E4-2. We can see the requirement is to complete the skydive tours worksheet for September 2020. And then the secondary question, what was the net income for the month end of September 30th, 2020? To give us some additional information here, this is really what we base our adjusting entries on, items A through to E. They also give us the first 2 columns of the worksheet, the unadjusted trial balance. You can see the first 2 columns of the worksheet in the solution was coming from that given information. That unadjusted trial balance, these amounts are really coming from the ending balances for each of these accounts in your general ledger. So then what we want to do is we want to look at each of these items, start with A, work through till we get done to E, do the adjusting entries, and we're going to do that in the adjustments column. That's what we're going to do next. Probably the most key part of the worksheet and that we really need to understand and get correct. You're going to see the rest of this is just pretty much extensions and moving some of the final amounts over to the respective financial statement columns, income statement, and balance sheet. So if we look at item A, it says that the business had corporate sales that were not recorded yet in the amount of $840, and we must accrue this service revenue. So recall that we do accounting on an accrual basis. Accruing just means that we need to record or recognize because the services have been performed. So we're actually recognizing our revenue now. We haven't been paid cash yet. So the 2 accounts involved in our adjusting entry is going to be accounts receivable and service revenue. So you can see that customer owes us some money for the services we have performed. So in accounts receivable under the adjustment column, we're going to debit that because it's an asset that's increasing. Denoted by item A, and that's going to get merged up to item A down here being your service revenue. Service revenue is increasing, so it gets credited. Once again, like we learned back in chapter 2 with debit credit theory, for each entry, the total of our debits and credits must balance, and they do in this individual case. We go back and look at the next adjusting entry. The given information says for item B, equipment amortization, the amount of $260 needs to be recorded. Amortization could be called depreciation. What this really is recognizing the amount of wear and tear. How much of that equipment value has now been used up, and in this case, for this particular month. In all cases when we're doing amortization, your 2 accounts involved will always be amortization expense for, in this case, equipment, and accumulated amortization. If we go back and look at how that gets recorded, we're looking at item B, amortization expense equipment. It's an expense, it's increasing, so we debit it for $260. The offset, this item B here, is a credit to accumulated amortization. The credit because accumulated amortization is a contra asset. Contra meaning opposite, it behaves the opposite way to all the other assets. All the other assets, when they're increasing, you normally would debit them, but in this case it's a contra asset, so it gets credited. And once again, that credit and debit balances out. If we look at item C, the business needs to accrue salary expense for $2,100 for work done but not yet recorded. So once again, we're doing adjusting entries always at the end of the month, and we're adjusting for things that have happened. In this case here, the work has been done by our employees. We haven't paid them yet. We need to recognize the work at the time it's been incurred. So we need to debit salaries expense. And since we haven't paid them, the offset will be that we owe them the money. So it's going to go to a payable called salaries payable, which will be credited. We take a look at that. You can see with item C, salary expense in the adjustment column gets debited for $2,100. And then the offset is this liability, salaries payable. And then once again in the adjustments credit column, we put the $2,100. Item D mentions that prepaid rent used is in the amount of $1,200. So what's happening now is at the end of the month, we used up 1 month's worth of the rent for that building that we have our business in. From the prepaid rent account, we need to reduce it by that. So the actual prepaid rent account is going to be credited. We're recognizing an expense right now because we've actually used up that cost, and we're going to debit rent expense. So we look at our rent expense in the adjustments column. It's an expense that's increasing, so we debit it for $1,200. The offsetting entry to it, item D up here, is to reduce prepaid rent, so we're going to credit it. And then the last entry is for supplies. They tell us that supplies worth $3,200 were used up during the period. So if that's what's used up, that's what's going to be our actual expense. So it's going to be salaries expense being debited. And we do need to reduce the asset supply account by the amount that's been used up, of course. So we're going to credit it. So once again, we take a look at our salaries expense account, the adjustment column. We're going to debit it because we're increasing that expense, and the offsetting credit is going to go to supplies, and then under the credit account we put the $3,200. Once you've done all these individual adjusting entries, we need to total up the debit and the credit column. We need to make sure they're in balance. No different than we start off with our unadjusted trial balance that was in balance. So when we add these columns up, we can see it is in balance, $7,600 each. We need to know that before we would move on forward. Okay. Now what we're going to simply do is take the extensions of the amounts in these first 4 columns. So to prepare this adjusted trial balance, we would look at our cash, and under our cash line, we start off with a debit balance of $14,240. We come across, there's nothing happening here in adjustments, so that number just moves over into this debit column for the unadjusted trial balance. There was no change to it. For accounts receivable, the ending balance in the unadjusted trial balance is $11,880. We come across and we see that we have a debit entry for our adjustments. So debits are alike, so a debit and a debit, we would add it together to arrive at a new debit balance in our adjusted trial balance of $12,720. If it had been an entry that was a credit and then following with another credit, again, if they're alike, we add them. If they're different, and we'll look at that in the case of prepaid rent, where we have a debit balance of $2,400, however, in the adjustments column, we have a credit entry going through of $1,200. Since this is a debit and the adjustment's a credit, debits and credits are opposites, so we need to subtract that. So when we subtract the $1,200 credit from the $2,400 debit, we end up with a debit balance, the larger of the two. So we end up with a debit balance in our adjusted trial balance of $1,200. So you can see you would go through and do it all line by line from here to end up with all these ending balances in your adjusted trial balance. The first 6 columns is sometimes, or is actually referred to as a 6-column worksheet. Full worksheet, though, of course, is the 10-column that we're looking at now. Once again, we need to make sure the adjusted trial balance is in balance. So we add up all the debits here. We end up with $114,860. We add up all our credit balances, and we've ended up with the same amount. So we need to again have that balance before we move forward. Now that we've done that, we can prepare in rough work our financial statements before we're going to prepare them in good form. And what I would suggest to do is let's do our income statement columns first. Makes sense, it comes first, and it's probably the easiest thing to do and explain. You're going to take the accounts that would actually go into an income statement. So you can see we have here service revenue and all our expenses. We're going to take it from the adjusted trial balance ending balances. So we have our service revenue credit balance of $24,440. It simply moves into that income statement account, as we learned back in chapter 1 in preparation of an income statement. Of course, all our expenses, we have debit balances here, under adjusted trial balance, move it into the debit column of our income statement. Once we've completed that, we would then add both these columns up. So we add up our debits, which in this case all our expenses, $11,920. Our only revenue account, $24,440. It's not that likely you would have both these be the same. You could, if they were, and if your revenue is exactly the same as all your expenses, you would be breaking even. There'd be no net income or no net loss. In this case, our revenue is greater than our expenses, which is a good thing. If you take the difference between the two, this plug figure here, $12,520, the difference between $24,440 and $11,920 is your net income. And again, it's net income because your sales or your revenue is greater than your expense costs. Add those two together to get your ending balance. Of course, your revenue balance just drops to the bottom here. Then what you want to do of all the remaining accounts, once you've moved these over into your income statement, all the other accounts would move over into your balance sheet. Your balance sheet is actually, in the case of the worksheet, representing both the balance sheet and the statement of owner's equity. So again, if we go back here and we look at all these ones that were assets, and as we know from early in the course, assets, liabilities, and the owner's equity goes on the balance sheet. So we have cash, debit column, simply moves over into the debit space for the balance sheet. Accounts receivable, and so on. We have amortization. It's again that contra asset, so that's why it's a credit balance. It moves over into the balance sheet because it is an asset, but it's just a contra asset behaving the opposite way. You have a couple of liabilities that move over. We have our capital amount that moves over into the balance sheet, and we have our drawings or withdrawals amount that moves over into the balance sheet. We total up this debit column to arrive at $102,940. We total up all our credits to arrive at $90,420. Take the difference between the two columns. That becomes your plug figure here, $12,520. Of course, you add that to the 90,000, you get $102,940. This number just drops down. They're both the same. Your check really on your work is the fact that the difference between your credit and debit column on your income statement is the same difference between your debit and credit column on your balance sheet, and that this difference actually appears on the opposite side than what this one did. This was a debit difference. This became a credit difference. Once again, debits and credits to balance. The other reason too, in this case, with this being a net income, that's actually increasing your net worth or your owner's equity, and that's what this would do by adding the credit here. The secondary part of the question was asking what was the net income for the month ended, and that's just simply this amount back here. And again, that was the difference between your revenue and expenses. So it was a net income of $12,520. Everyone have a great day, and I'm Bob Cromwell.